as he breaks down just really the sales process of with IULs, what he's doing in the homes that's been helping him so much to be able to help these families. And IUL is an amazing product. So I'm gonna stop talking because I'm gonna let the professional get to it. So Adam here, are you on?
Yes, sir. Ready to go.
Awesome. All right, man. You're coming in loud and clear. I'm gonna go ahead and mute out, and I'm gonna let you take over, man.
Okay, very good. So I'm going to just be upfront with you folks. A lot of what we're going to discuss today are things that I have learned, not just for myself from reading, but a lot of it's been from talking to other people at the Alliance, which I think is really important for us to do. Is talk to people and ask questions. One of the things I really appreciate about our organization, we have a lot of people who are just so knowledgeable, and they are happy to share what it is they have done. And then you pick up these gems here and there, and you're able to piece things together and come up with an approach that just makes you more and more money. And so I don't want you to think that this is, something that I've come up with all on my own. There are a lot of people who are owed the credit for what we're going to discuss today. Who is a good IUL lead? Well, you're going to find really people who want maybe $25,000 or more in coverage. Maybe they'll, and they're 75 or younger. They might qualify for an IULE with Mutual of Omaha, for example. There are individuals who probably want more than just final expense insurance. They want to leave some money behind for their loved ones, maybe to help pay the bills when they're gone, in addition to paying for their funeral costs. But there are people out there, especially those in their 20s, 30s, 40s, 50s, that are going to be excellent candidates for IULs because they can use them to save for the future, especially saving for retirement. And so how do you find those individuals? What do you do? Well, when I'm in the home or talking to someone on the telephone, I rarely ever go into a home anymore. I do all my appointments over the telephone and Zoom these days. But whatever the case, when you're talking to someone who wants to get insurance, I ask them some questions. And these are the questions I ask them to help me understand what they're looking to do, and also to pique their interest. I'll ask them, what do you want to accomplish with your life insurance? And sometimes people say, well, I want to provide enough money for my family to survive, or cover the mortgage, or, pay for my funeral. But a lot of people don't know what to say to that question. And so I'll give them some scenarios. I'll ask them, all right, do you want to make sure your family has enough capital to care for themselves and mourn your loss? Figure out what their next steps are going to be? Or do you want your life insurance to create generational wealth? Or do you want your life insurance to help you save for retirement? And when you ask that third question to people, they're like, save for retirement? What does that mean? And see, now you've hooked them. So you got their interest, and now they want to know how that works. And so I just explained to folks, life insurance can be used to what is called a 7702 plan, or a tax-free retirement account. I love using that phrase, TFRA, tax-free retirement account. And so I'll go into explain to them what that means. Most people today who are saving for retirement are using status quo tools, such as pensions, which are fewer and far between these days. 403Bs, maybe if they're a nurse and they work at a hospital, or a teacher, or 401Ks, some other individual retirement account, maybe a Roth. And financial advisors love those tools because they can park their money, usually in a mutual fund, and they earn a commission every year. And the more money they're managing, the more money they make. And so they just love using these status quo tools because they're going to earn a commission every year, whether the market goes up or down. They're making their commission, and they can just park your money. And it's good that folks are using those tools. I commend them that they're using tools to save for retirement. You don't want to make people feel bad or foolish or dumb. You want to commend them. So it's good that you are saving for retirement, because so many Americans today are relying on Social Security income alone. So it's good that you're saving for retirement. But the people who often benefit from these various vehicles that people use are going to be the financial advisor, as I mentioned, and the federal government, because The government loves those tools. They create tax revenue for the federal government. They're the winners. But those tools do not solve for two very important things: taxes and market volatility. And taxes are at their lowest that they've been in the history of this country, near the lowest they've been in the history of this country. They were their lowest right about the maybe like the 90s, thereabouts. They went up some, and then during the last few years, they've gone down some, but they're near the lowest that they've been in many years. And so I ask people, what do you think is going to happen in the future? Are taxes going to stay the same? Are they going to go up? Or are they going to go down? And people often say they're going to go up. And that's likely to be the case. Either Congress gets its spending under control and they bring the national debt down, or they do that and raise taxes. Either way, it is likely that taxes are going to go up in the future in coming decades, not go down. And so we need to solve that problem. We need to solve for market volatility, because the stock market, it is very volatile these days. It takes on average 6.6 years for an investor to recover the money they've lost in a downturn. So if I have 100,000 in the stock market and I lost 20K, on average, it's going to take a person 6.6 years to make that 20K back up. In that period of time, they haven't made money. They have simply recovered what it is they lost, and now they're making money again. See, so we need to solve for those two problems. And that's what TFRAs or 7702 plans will do. And these tools, I explain to folks, are used by the wealthy to avoid paying taxes. They're used by large corporations. GE pays big bonuses to their top executives through TFRAs. Bank of America, which I think is hysterical, because Bank of America is out there peddling mortgages, but what are they giving their executives? Real estate? Nope, they're giving their executives bonuses in the way of TFRAs, helping to save for retirement using TFRAs. So then I asked them, when you retire, do you want to maintain your current lifestyle, or are you happy to settle for less? What do you think the answer to that question is going to be? They're going to say that I want to solve for, I think that I don't want to settle for less. I want to maintain my current lifestyle. That's what they're going to say. So then I asked them, okay, so has your financial advisor then shown you what your income is likely to be when you retire using your current plan? And people will usually tell me one of two things, or a combination. They'll tell me, I don't have a financial advisor, or if they have one, their financial advisor has not shown them anything. They just simply, sold them something, and that was pretty much it. So this is where I start then. I say, okay, let's begin. Let's start from the beginning. I'm going to ask you some questions to kind of get a better understanding of your financial picture, because if I don't do that, that would be like a doctor coming into an exam room and writing a prescription without conducting a physical. That would be medical malpractice. Well, for me to give you some advice on how to use a TFRA without knowing your circumstances would be really like financial malpractice. So I need to understand your situation. I asked them these questions. What is your current age? What is your target retirement age? Are you married? Do you have children? How is your health? Now that's important, because if they're going to qualify for an IUL, I have to know that their health will allow for it. And so how do I explain that to people? I explain, has your financial advisor calculated what your healthcare costs are likely to be in the future? That can be a very expensive part of your budget. So has he or she factored that in? No? Okay, then tell me, how's your health? Do you take medications? Has your doctor diagnosed you with any conditions? Then I ask them too, what's your living situation? Do you rent or do you own? Many people tell me that their mortgage is paid off, or they will have it paid off in like 5 or 10 years, and I commend them for that. But see, in my mind, I know that that's going to free up revenue in the future. What tools are you currently using for retirement? Are you using an IRA, 401k, Roth, savings? Do you have money set aside outside of your retirement account? That's a good question, because now I may know that they've got other IRAs or other 401ks out there I can roll over and help them with those. What types of products are you using? How much are you currently saving per month? this is another key question. What is your contribution to your 401k? What percentage is it? What is your income? And what is your company match? Now, that is a very, very important question to ask, because that's how you find money to help them put into a TFRA. Let's say, for example, that a person is making $50,000 a year, they're putting in 9%, but their company match is only up to 5%. See, I can do some simple math and find out that they're probably contributing about $160 more per month than they should into a tax deferred account. They need to be putting that money that's not being matched into a tax-free account. See, so I've just found money. I'm just moving it from one column to another without adding to their budget any. So that's an important question to ask. Is this amount your income alone, or does it include more than one income stream? See, so if they tell me it's 100K a year and I find out it's for husbands and wives, I ask, if I'm talking with the husband or the wife, well, what is your income? Okay, I'm going to deal with one individual in the household at a time and help them one at a time. Do you think your income will increase? What's your plan for the increased income? What are your liabilities? Like what's the monthly nut you got to make to pay all your bills? That's important because it shows them typically the gap between what it is they're earning and what it is that they are spending. And that helps them see that there's some room in there often to set aside some money to save for retirement. I may not be telling them that, but that's what's going to be going through their head here as we go through the numbers. And I get very, very specific amounts with them. Is there anything else you're planning financially, financially in your road to retirement? Are you thinking about taking care of college for kids, caring for aged parents? Do you want to set aside money for charities? So I'm helping them kind of paint a picture of what retirement looks like. And with that information, what I'm going to do is I'm going to write it all down. And I am not going to show them any numbers right then and there, because I can very quickly, but I want to give them a few days to think about what it is I've asked them, because sometimes people remember more like the next day that they didn't think to tell me when I was there or when I was talking with them. And that information can change the approach somewhat. So I want them to think about it, but I also want to go back to my computer and do some calculations. I want to show what their current retirement plan is going to look like and prepare a simple presentation for them. And I tell them I'm going to do that. I'm going to prepare a presentation using commonly available tools that will show them what their retirement income will be. And I stress commonly available tools. I explain, I don't want you to think that this is something that only a financial advisor could have done for you. You can do it too, and I'll show you how. And I'm doing that because what I'm going to use is retirementcalculator.net or calculator.net and go to their retirement calculator. See, so I'm not coming to them with some fancy software that they're not going to have access to. I'm going to go to them with retirementcalculator.net. And I'm going to enter all the information that they've told me in my conversation with them and prepare a simple visual presentation. Let me share my screen here with you and I'll show you what I did. Here's retirementcalculator.net. What I've done is I've entered the information they've given me into these fields: their age, planned retirement age, life expectancy. It defaults at 85, but I like choosing 90 because I want to help individuals not, I don't want their money to dry up before they expire. I want to make sure that they have enough to enjoy through all their retirement years. So I choose age 90 instead. Here's their current income. Their average income increase, it's probably 3% on average. It could be less. And then the income they're going to need after retirement. So they told me that they want to maintain their current standard of living. That means they're probably going to need 75% of their current income, because they'll probably have their house and cars and some things paid off, and they're probably going to need about 75% of their income in retirement. The average investment return, you can Google it and find it. It can be anywhere from 7 to 10. I like to underpromise and overperform, so I choose 7. The inflation rate is there. I calculate their Social Security income using ssa.gov. And I entered this person's age and their retirement income age in 2045 is going to be $29.47 a month. I enter that into the system, their current savings if they have any, and then I calculate it, and it tells me everything I need to know right here. It tells me that you will have, using the status quo approach, this amount, 133,000, but what you need is 1.64 million. See, I didn't tell them that. The math told them that. If I ask people, okay, what do you want to set aside for retirement? They're going to tell me, well, I'm going to spend $100 a month. That will do nothing but buy them life insurance. It is not going to help them save for retirement. But when you show them the number, now they realize what they have to have versus what it is they're doing. And it's very sobering for people. And it moves them all on their own to realize, okay, I need to do better because I am way behind. So I tell them the number that you need to save actually to get to where you want to be versus where you are is $2,482 per month. Now, there are people who will tell me that's exactly what I want to spend. And I've got clients in recent weeks who've done that. I've got other clients who say, well, I can't do that. I tell them that's very common. What can you do? Well, I can do 1,000 a month. Great. Let's do 1,000 a month. And so what can we do with 1,000 a month? I will go back to between that appointment and the next. I'll then set up an appointment to show them a presentation to show them how to solve their problem. A third appointment. And I will show them an illustration I have created for them on F&G Sales Link. And I will show them, let's just say you're doing $1,000 a month. Where will that take you? Where will you go with $1,000 a month? And it helps them realize that they can do something instead of nothing. They may not be able to reach their goal right now, but they know they have a goal and they're working towards that goal. And it moves them then to, to do something. So this illustration that I created here is using this average client. It will show them what their income can be, setting aside $1,000 a month into a TFRA, which you and I both know is an IUL. And so I go down here to the table, and I show them that their income can be at age 68, $46,514 a year, tax-free. So this is on top of their Social Security income. In addition to, it'll be $46,514. So what I have done is I have improved their situation by about 35–40%. Have I solved it completely? No, but I worked within their budget, and I tell them, okay, I've improved your situation by 40%. And people feel good that they're doing something, because what they're currently doing is not going to work, and they're going to be broke. They're going to have to settle for less, and they don't want to do that. So see, folks, instead of me telling them what they have to spend, I have shown them what the math is. They have come to their own conclusion about what it is they need to spend. Then I've entered the numbers and showed them what the numbers look like, and help them understand I've improved their situation by whatever percentage amount it is. Sometimes it's as low as 15%, sometimes it's as high as 75–80%. It'll vary from client to client. And I tell them too, these are very conservative estimates. I tell them I like to use F&G because F&G likes to underpromise and overperform. This is $46,500 a year based on an interest rate of 7.03%. But I tell them this index account has actually on average been earning significantly more than that. And so I'll scroll down to the page that shows what the historical average is, and it's 9.61%. Or if I chose the S&P 500, it's 10.54%. So they're likely to have more, but the illustration shows an example of 7.03%, and they like to underpromise and overperform. Now, keep in mind, folks, when you have done this now, this illustration, you're going to get paid, with at least with F&G, on a target, not on the annual premium in this case. So if they're spending $12,000 a year, don't start calculating, I'm going to make 10 grand on that policy. No, you made your commission at $3,566, the actual cost of insurance. Okay, that's where your commission comes from. All right. So I will always use in my illustrations to show these numbers. The S&P 500, at least in recent months, I've started doing that because Barclays Trailblazer, which outperforms the S&P, does not illustrate as well as the S&P does, even though it'll overperform the S&P 500. You see here, it's in this case it's not, but typically that is the case. All right, so that's why I chose the S&P 500 as the index. Then I go on to explain to them too that this is tax-free money, and they can put more money into it in the future if they want to. They can dump some money into it if they want to. But this is a key point for you agents to remember: is they can only do that up to the level where they can, and not turn their IUL into a modified endowment contract or a MEC. Because once that happens, it becomes, as far as the IRS is concerned, an investment tool, no longer a life insurance tool. And they're going to be paying capital gains tax forever. They can't go back because they've overfunded their IUL. So what I do in order to help them avoid that is I tend to give them more in the way of death benefit than $1,000 will buy. And there's a couple reasons why I do that. They want to have room for future monies to be dumped into it if they want to. And if you make them buy another IUL in order to do that, they may not qualify for an IUL. Maybe their health has changed and now they don't qualify for an IUL, and they don't have the room now to do that. Or maybe they do have the health to do that, but now they have to get a separate IUL. So I want to give them some room here in the space amount so to put more money into it in the future. And by doing that too, you will get paid better as well. You will get paid better. So it's a win-win for you and for the client. Okay, so those are that's basically the there's probably more to it that I'm not thinking of right here and now, but those are the highlights. That's basically what it is I'm doing with folks to help them save more for retirement. I create the application on the third appointment and get it submitted. Schedule, often a paramed is, not always, but often a paramed is required. I try to get that schedule as soon as possible for them. To try to get a nurse that comes out to their house to help them get that test done, the physical, and I look forward to the money rolling in. It's gotten to the point now, folks. So this is pretty much all I'm doing. I rarely ever write a final expense or even a term policy. I've just been trying to focus on writing tax-free retirement accounts, and that will largely explain why it is my numbers are the way they are. This has also led me doing more in the way of annuities. This afternoon, I go pick up a check for $95,000 from a client. And it was money that came from discovering what their financial situation was as I was preparing a tax-free retirement account presentation for them. So you get to find money to do 401k rollovers. You get to write more IULs with a higher annual premium or larger target premium, so you make more money. And the client gets this beautiful check every year, in this case for 46+ K a year, tax-free, that they can use in retirement. It's just like, why wouldn't I be doing this? So this is pretty much all I do these days. If you have any questions, I'd be happy to help you, and we'll close things up. My telephone number is 678-493-1755. 678-493-1755. Okay? 678-493-1755. I'll try my best to help you out, but if I don't know the answer, I know somebody who does. And and share your successes, share your experience with others. Help them to learn how to do these things too. That's a beautiful thing in our organization, is that we've got so many that are so happy to share, and they don't view each other as a competition. They're just happy to share what it is they've learned to help others win and succeed too. Best wishes to you all. Have yourselves a wonderful week. I know you're gonna go out there and do great, and I look forward to seeing you all in Miami. Cindy and I will be there. We look forward to seeing you. If we don't see you, please walk up and say hello. We'd like to see you there, and we're gonna have a great time in beautiful Miami this week. You guys take care now. Have a good week. Enjoy the rest of your afternoon.